Welcome back to CMA USA Exam Coach. This is the second part of our series on cost volume profit analysis under the Decision Analysis section of your CMA Part 2 syllabus. In this episode, we'll go beyond the basics and cover some advanced and practical CVP tools that are frequently tested in the CMA exam. Here is what we'll be learning today. Break-even point for multiple products, then margin of safety and the margin of safety ratio. And we have to cover the composite or basket method for CVP analysis. Then we have the expected value approach in decision-making. And finally, the deterministic approach. These tools are very useful in real-world business analysis and are crucial for answering CMA exam questions correctly. So let's begin.
Let's begin with the concept of break-even point for multiple products. In the real world, most businesses don't sell just one product. Instead, they offer a range of products. For example, a bakery might sell cakes, cookies, and bread. Each product has a different selling price, different variable cost, and different contribution margin. So, when we calculate the break-even point for such a business, we can't simply apply the single product break-even formula. Why? Because the total contribution margin depends on the sales mix, that is, the proportion of each product sold. To handle this, we use the composite break-even approach. This method assumes a constant sales mix, which means we assume that products are sold in a fixed ratio. Then we calculate the weighted average contribution margin per unit, based on that sales mix. This allows us to apply the break-even formula in a way that reflects the combined performance of all products together. Before we start calculating the break-even point for multiple products, we need to understand a key concept called the product mix percentage. This tells us how much each product contributes to the total number of units sold. It's also known as the sales mix ratio, and it's very important because the contribution margin depends on the mix of products. Let's understand this with a simple example. Imagine a company sells two products, Product A and Product B. In a given sales period, Product A sells 50 units, and Product B sells 70 units, so the total units sold equals 50 plus 70 equals 120 units. Now we want to calculate the mix percentage of each product. This is done by dividing the units of each product by the total units. For Product A, 50 divided by 120 equals 0.4166, or 41.66%. This means that 41.66% of the total units sold are Product A. For Product B, 70 divided by 120 equals 0.5833, or 58.33%. So, 58.33% of the total units sold are Product B. This sales mix helps us calculate the weighted average contribution margin, which we will use in the composite break-even formula. Now that we've seen how to calculate the product mix using an example, let's quickly look at the formula behind it. The formula to calculate the mix percentage is very simple. Mix percentage equals quantity of a product divided by total quantity of all products. So, going back to our previous example, we had 50 units of Product A and 70 units of Product B. The total units sold were 120. Using the formula for Product A, mix percentage equals 50 divided by 120 equals 41.66%. For Product B, mix percentage equals 70 divided by 120 equals 58.33%. This is exactly how we calculated the sales mix or product mix in our earlier example. Understanding the product mix is important because we'll now use these percentages to find the composite contribution margin, which helps in calculating the break-even point for multiple products. Now, let's understand the formulas used to calculate the break-even point for multiple products. As we've discussed earlier, in a business that sells more than one product, each product usually has a different selling price, variable cost, and contribution margin. So we can't apply the regular single product break-even formula here. Instead, we use a weighted average approach based on each product's mix percentage. Let's look at the first formula, break-even quantity. It is calculated as break-even quantity equals to fixed cost divided by contribution margin per unit multiplied by mix percentage for Product A. plus contribution margin per unit multiplied by mix percentage for product B, and so on for all products. In other words, break-even quantity equals 2. Fixed cost divided by, open bracket, CM per unit of product A times its mix percentage, plus 100 million per unit of product B times its mix percentage, plus any additional products. This gives you the total number of units, a mix of all products combined, that the company needs to sell to reach break-even. Now, let's look at the second formula. Break-even revenue. Break-even revenue equals to fixed cost divided by contribution margin ratio of product A multiplied by its revenue mix, plus contribution margin ratio of product B multiplied by its revenue mix, and so on. Again, we are applying the same concept of weighted average, but instead of working in units, we are working in revenue terms. So once again, break-even revenue equals 2. Fixed cost divided by, open bracket, CM ratio of each product times its share of total revenue. We have the equations to calculate the mix percentages. For calculating revenue mix, the formula is revenue mix equals revenue divided by total revenue. And for quantity mix, the formula is quantity mix equals quantity divided by total quantity. Let's do one practical example. The question is, how many units of each product should be sold for the company to reach the break-even point? Let's go through the given data carefully. We are told that the company sells 2 products, product A and product B. Let's start with the details for product A. Selling price is $10. Variable cost is $5. This means the contribution margin per unit is $5. The quantity mix is 60%, which we can also express as 0.6. Now for product B, selling price is $25. Variable cost is $16. This gives us a contribution margin per unit of $9. The quantity mix is 40%, or 0.4. We are also given that the total fixed cost is $132,000. Now, the company wants to know how many units of product A and product B should be sold to reach break-even, which means no profit and no loss. At break-even, the total contribution margin exactly covers the fixed cost. Let's solve this in steps. Step 1. Calculate the weighted average contribution margin per unit. Since the company is selling a mix of 2 products, we need to calculate a weighted average contribution margin per unit, based on the quantity mix. The formula is weighted average contribution margin equals contribution margin of product A multiplied by quantity mix of A, plus contribution margin of product B multiplied by quantity mix of B. So that is $5 multiplied by 0.6, plus $9 multiplied by 0.4. Now let's do the math. 5 multiplied by 0.6 equals 3. 9 multiplied by 0.4 equals 3.6. Now add them together. 3 plus 3.6 equals 6.6. So, the weighted average contribution margin per unit is $6.6. Step 2. Calculate the total units required to break even. Now we use the break-even formula. Break-even quantity equals fixed cost divided by weighted average contribution margin per unit. That means break-even quantity equals $132,000 divided by $6.6 per unit. Now let's divide. 132,000 divided by 6.6 equals 20,000 units. This means, in total, the company needs to sell 20,000 units to break even. But this is the combined total of both products. Now we need to break this down into how many units of A and B must be sold. Step 3. Apply the quantity mix. We were given the quantity mix. For product A, it is 60%. For product B, it is 40%. So now we multiply. Product A units equals 20,000 multiplied by 0.6, which gives us 12,000 units. Product B units equals 20,000 multiplied by 0.4, which gives us 8,000 units. Final answer. To break even, the company must sell 12,000 units of product A, and 8,000 units of product B. This product mix will generate enough contribution margin to exactly cover the fixed costs of $132,000. At this level, the company will be at break-even, no profit, no loss. And that's how we calculate the break-even point in a multi-product situation, using quantity mix and contribution margins. Now that we have calculated the break-even quantity for each product, let's take it one step further and calculate the break-even revenue. We already found out that, to break even, the company needs to sell 12,000 units of product A and 8,000 units of product B. Now we will convert these quantities into revenue by multiplying the number of units by their respective selling prices. Let's start with product A. We have 12,000 units. Each unit is sold at $10. So, break-even revenue from product A is 12,000 multiplied by $10 equals $120,000. Now for product B, we have 8,000 units. Each unit is sold at $25. So, break-even revenue from product B is 8,000 multiplied by $25 equals $200,000. Now let's add both together. $120,000 plus $200,000 equals $320,000. Final answer. So the total break-even revenue is $320,000. This means the company must earn a total revenue of $320,000, comprising both product A and product B in the given sales mix, to just cover its fixed and variable costs. At this level of revenue, the company will not make any profit, but it will also not incur any loss. This is the break-even point in revenue terms. Now let's understand the margin of safety with a simple example. Suppose we have a company called ABC Company. They've already calculated that their break-even point is 75 units per month. This means if they sell 75 units, they will exactly cover all their fixed and variable costs. No profit, no loss. Now let's say in a particular month, the company actually sold 100 units. So here's the question. How much sales are they making beyond the break-even point? The answer is simple. 100 units minus 75 units equals 25 units. This extra 25 units is what we call the margin of safety. This tells us that the company can afford to lose sales of up to 25 units without falling into a loss. Even if sales drop by 25 units, the company will still be at the break-even point, still not making a loss. So that's why we say, the sales above the break-even point are called the margin of safety. Let's take another situation. Imagine the company is performing really well, and it sells 200 units. Now, how much is the margin of safety? Again, subtract the break-even quantity. 200 units minus 75 units equals 125 units. That means the company can tolerate a drop in sales of up to 125 units and still not incur a loss. So what's the key takeaway here? The higher the margin of safety, the safer the business is. A company with a high margin of safety has more room to absorb sales decline before it starts making losses. But if the margin of safety is very low, it means the company is very close to the break-even point, and even a small drop in sales could lead to losses. This is why understanding and calculating margin of safety is extremely important for business planning and risk analysis. Margin of safety simply tells us how much sales can drop before the company reaches the break-even point. In other words, it shows us how much sales revenue we are earning over and above the break-even revenue. This is a very useful measure to understand the risk level of the business. Let's put it this way. First, we calculate how much total revenue the company is currently generating. Then we subtract the break-even revenue from it. The result is called the margin of safety. We can write it as a formula. Margin of safety in revenue equals revenue minus break-even revenue. This tells us how much room the company has before it starts operating at a loss. The break-even point itself is like a danger line. Up to that point, the company is not making profit, but not making loss either. It's in a no profit, no loss situation. Now, to better compare the risk levels across different companies or even different time periods, we don't just use the margin of safety in dollar value. We also use something called the margin of safety ratio. Let's now talk about how safe the business is from making losses. The margin of safety ratio. We already know that margin of safety tells us how much sales can drop before the company hits the break-even point. But to make better comparisons between different businesses or different time periods, we often express this safety margin as a percentage. That's where margin of safety ratio comes in. It simply tells us what percentage of our total sales are above the break-even point. Now, there are two ways to express the margin of safety ratio. One is based on quantity, and the other is based on revenue. Let's look at both equations. First, if we are using quantities, the formula is margin of safety ratio equals margin of safety quantity divided by total quantity. For example, if the company sold 100 units and break-even is 75 units, then margin of safety is 25 units. So, 25 divided by 100 gives a ratio of 25%. This means 25% of our total sales are above break-even. That's our safety buffer. Now let's see the second version of the formula based on revenue. Margin of safety ratio equals margin of safety revenue divided by total revenue. In this case, if your total revenue is, let's say, $200,000, and the break-even revenue is $150,000, then margin of safety revenue is $50,000. So 50,000 divided by 200,000 gives 25% again. So whether you calculate it in quantity or revenue, you get the same kind of insight. How much of your sales are above the break-even level as a percentage? This ratio is especially helpful when you're comparing different divisions or different companies, because it tells you who has more buffer, who is at less risk, and who is close to breaking even. And remember, a higher margin of safety ratio means lower business risk. Let's now understand a very useful technique when we are dealing with multiple products. It's called the composite method, or sometimes referred to as the basket method. In real business situations, companies usually sell more than one product. Each product might have a different selling price, a different variable cost, and even a different contribution margin. So, if we want to calculate the break-even point for the entire business, we need a way to combine all the products into one formula. That's where the composite method helps us. We assume a sales mix, or a basket of products, based on the proportion in which different products are sold. Let's understand this step by step. First, we identify how many units of each product are normally sold together. For example, if a company usually sells 3 units of product A and 2 units of product B, then we treat this group, 3 of A and 2 of B, as one sales basket. Next, we calculate the contribution margin for this entire basket. We do this by multiplying the contribution margin of each product by the number of units in the basket, and then summing up to get the total contribution margin per basket. Once we have the contribution per basket, we can apply the regular break-even formula. Break-even quantity of baskets equals fixed cost divided by contribution per basket. And finally, once we know how many baskets we need to sell to break even, we can multiply by the number of units per product in each basket to get the individual product quantities. This method is very useful because it lets us handle multiple products in a fixed ratio and still calculate break-even in a structured way. In the next slide, we'll solve a full example problem using the composite or basket method. Let's now solve a practical example using the composite or basket method. We are given the data for 2 products, product A and product B. Let's go through the details. For product A, selling price equals $10. Variable cost equals $5. So contribution margin per unit equals 10 minus 5, that is $5. Quantity in the sales basket is 100 units, and the mix percentage is 33%. For product B, selling price equals $20. Variable cost equals $10. So contribution margin per unit equals $10. Quantity in the sales basket is 200 units, and the mix percentage is 67%. The fixed cost is given as $50,000. Now, to calculate the break-even point using the basket method, we first need to calculate the contribution per basket. So, we multiply each product's contribution margin by the number of units in the basket. Product A, $5 times 100 units equals $500. Product B, $10 times 200 units equals $2,000. Now, the total contribution per basket equals 500 plus 2,000, which is $2,500. Next, apply the break-even formula. Break-even number of baskets equals fixed cost divided by contribution per basket. So we have break-even quantity equals $50,000 divided by $2,500, which gives us 20 baskets. Now, to find the break-even quantity of each product, break-even quantity of product A equals 100 units per basket times 20 baskets. That gives us 2,000 units of product A. Break-even quantity of product B equals 200 units per basket times 20 baskets. That gives us 4,000 units of product B. So to summarize, the company needs to sell 2,000 units of product A and 4,000 units of product B in the given mix ratio in order to reach the break-even point. Let's now solve another break-even question using the composite method, where the quantity mix is given directly. In this case, the company sells two products, product C and product D, in a quantity mix of 8:2. Let's go through the data. Selling price of product C is $10. Variable cost of product C is $4. So, the contribution margin per unit of product C is 10 minus 4 equals $6. Selling price of product D is $5. Variable cost of product D is $2. So the contribution margin per unit of product D is 5 minus 2 equals $3. The fixed cost for the company is $30,000. We are also given the quantity mix, which is 8 units of C for every 2 units of D. Now let's calculate the contribution margin for the full basket based on the 8:2 mix. Product C contributes $6 times 8 units equals $48. Product D contributes $3 times 2 units equals $6. So total contribution margin for the sales mix basket is 48 plus 6 equals $54. Next, we calculate the number of baskets needed to break even. Apply the formula. Break-even quantity equals fixed cost divided by contribution per basket. So 30,000 divided by 54 equals approximately 555.55 baskets. Now let's calculate the break-even quantity of each product. Product C equals 555.55 times 8, which gives us approximately 4,444 units of product C. Product D equals 555.55 times 2, which gives us approximately 1,111 units of product D. So the company needs to sell 4,444 units of product C and 1,111 units of product D to reach its break-even point in this given sales mix. Now let's discuss two important decision-making methods used in cost-volume profit analysis, especially under uncertainty. These are the expected value approach and the deterministic approach. Let's begin with the deterministic approach. In the deterministic approach, we assume that all the input values like selling price, variable cost, sales volume, and fixed cost are known with certainty. That means we calculate profit or break-even using single fixed values without considering any variations or probabilities. This approach is simple and straightforward, but it does not reflect the real-world uncertainty that managers often face. For example, if we know our selling price is $50, variable cost is $30, and fixed cost is $20,000, we simply apply formulas using those exact values. There is no room for variability or changing scenarios. Now let's understand the expected value approach. The expected value approach is used when future events or outcomes are uncertain and can occur with different probabilities. In this method, we assign probabilities to each possible scenario, such as different sales levels, costs, or contribution margins, and calculate the expected value, which is a weighted average. This method is more realistic and helps in risk-based decision-making. It answers the question, on average, what result should we expect over the long run, given the range of possible outcomes and their probabilities? We calculate expected value equals the sum of all possible outcomes multiplied by their respective probabilities. This approach is especially useful in uncertain environments like fluctuating markets, seasonal sales, or during product launches where outcomes are not guaranteed. In the next slide, let's solve a simple example using the expected value approach to make the concept clearer. Let's now understand the difference between the deterministic approach and the expected value approach through a simple example. Here's the question. A company is estimating the selling price of a product, but the price may vary depending on the market. The possible prices and their respective probabilities are given as follows. $999 with a probability of 50%, $1,000 with a probability of 10%, $1,050 with a probability of 20%, and $1,100 with a probability of 20%. Let's first apply the deterministic approach. In the deterministic method, we simply take one fixed value, usually the most likely or the average-looking value. So here the price will be considered as $999. There is no consideration for uncertainty or variability. So the answer using the deterministic approach is price equals $999. Now let's use the expected value approach, which accounts for the probability of each price. We multiply each price by its corresponding probability and then add all the results. Expected price equals 999 times 50%, plus 1,000 times 10%, plus 1,050 times 20%, plus 1,100 times 20%. Let's calculate. 999 times 0.50 equals 499.5. 1,000 times 0.10 equals 100. 1,050 times 0.20 equals 210. 1,100 times 0.20 equals 220. Adding all these values, 499.5 plus 100 plus 210 plus 220 equals $1,029.5. So, the expected selling price based on probability is $1,029.5. This clearly shows how the expected value approach gives a more realistic, risk-adjusted estimate, while the deterministic approach sticks to a fixed number without considering variations.
As we discussed at the beginning of this decision analysis section, there are several important tools and techniques used by managers to make better decisions. In the last few episodes, we have now completed one of the most important tools, the cost-volume-profit analysis, along with all related topics like break-even analysis, contribution margin, and margin of safety. These concepts help managers understand the impact of cost and volume on profitability, and support in planning, pricing, and risk analysis. Now that we've covered CVP thoroughly, in the next episode, we will begin with a new topic, marginal analysis. Marginal analysis is another core decision-making technique, used for evaluating additional costs and additional benefits while making short-term business decisions. Before we wind up this session, let's quickly summarize what we covered in the cost-volume-profit analysis, Part 1 and Part 2 episodes. In CVP Part 1, we started with the basics. We discussed the characteristic features of CVP analysis, understanding what makes this technique useful for decision-making. Then we looked at the key assumptions behind CVP analysis, like constant sales price, fixed cost behavior, and how the model assumes a linear relationship. After that, we moved on to target quantity and target revenue, learning how to calculate the required sales level to achieve a specific profit target. Next, we explored the break-even analysis, a key concept that shows the point where total revenue equals total cost, meaning no profit and no loss. Finally, we simplified the break-even formulas and understood how they can be applied using both unit-based and revenue-based approaches. In CVP Part 2, we went further. We explained how to handle multi-product CVP analysis where a company sells more than one product, and how the sales mix or quantity mix plays a critical role. We learned to calculate the break-even point for multiple products, using both revenue mix and quantity mix methods. We also understood how to use the composite or basket method to analyze combined product sales. After that, we explored the margin of safety, what it means, how to calculate it, and how to interpret the margin of safety ratio to measure business risk. Lastly, we discussed two important decision-making techniques: deterministic approach and expected value approach, and we solved practical problems using both. These concepts form the backbone of cost-volume profit analysis and are essential for any managerial decision-making under uncertainty. Thank you so much for watching these two detailed episodes. Keep practicing questions from your CMA textbooks and revise each concept with clarity. See you in the next episode!